Phillips 66, ticker PSX, just delivered a massive Q2 earnings beat. Adjusted EPS came in at $9.41, which, I mean, completely crushed the $7.50 consensus.
Oh, yeah. And revenue hit $52.04 billion, easily blowing past the expectations of $43.6 billion.
Oh, it's totally off the charts.
Exactly. And Q3 guidance is just as aggressive, you know. Crude capacity utilization is projected in the mid-90% range. Plus, turnaround expenses are tightly capped, like $100 to $120 million.
Corporate costs sitting between, what, $325 and $350 million?
Right, exactly. But, you know, the stock reaction was honestly pretty bizarre at first. Shares actually dropped 2.3% to around $200 on immediate profit-taking.
Which feels like a classic sell the news reaction, just Wall Street punishing a flawless report card because they, well, already expected it.
Yeah, but then this fierce 7-day rally took hold. It added $16 billion in market cap, pushing shares to $233.61.
Wow. So today's deep dive into these earnings reports is really about finding out what drove that $16 billion reversal, right?
Right, because looking under the surface, the segment details completely justify the rally. Refining alone generated $3.086 billion in adjusted pre-tax income.
Wait, $3 billion? Because in Q1, that was just like $208 million, right?
Yeah, a massive leap. Realized margins more than doubled to $24.08 per barrel. And the beat was really broad-based, too. Midstream posted $785 million.
And renewable fuels completely reversed a Q1 loss, didn't they?
They did, yeah. They posted a $544 million gain, which was heavily driven by higher regulatory credits.
Okay, those numbers are huge. But it forces us to ask, I mean, is this sustainable? We're looking at explosive crack spreads right now.
Right.
And I have to wonder if this is a permanent new normal or just a temporary distortion from Middle East geopolitical tensions and tight fuel inventories.
Well, the company definitely remains highly sensitive to those macro factors. But regardless of whether those specific margins hold long-term, what management did with this quarter's cash windfall permanently alters the stock's profile.
You talk about the $7.26 billion in operating cash flow.
Exactly. They took that staggering cash flow and immediately executed a highly aggressive balance sheet restructuring. In a single quarter, they slashed total debt by $6.6 billion.
That is wild. They brought net debt down to $16.46 billion.
Right, which means they hit their year-end 2026 target quarters ahead of schedule.
It's literally like paying off your 30-year mortgage in 5 years. Suddenly, the financial models predicting your behavior just have to be completely rewritten.
For sure. And on top of that rapid deleveraging, they returned $887 million directly to you, the shareholder.
Right, through dividends and buybacks.
Yeah, maintaining that pledge to return over 50% of operating cash flow. When a company de-risks its balance sheet that rapidly, valuation models adjust upward across the board.
Which makes me think about that recent Zacks rank upgrade to a buy. Is that rapid deleveraging and, structural cost cutting the primary catalyst there?
I'd say so, yeah. Wall Street isn't just reacting to a temporary refining spike, but with the stock trading near all-time highs, there are real forward-looking risks you need to weigh before jumping in.
Right, we definitely can't ignore the headwinds.
The core risk is, well, that ongoing sensitivity to global commodity cycles. I mean, if margins revert to historical averages, the cash flow story instantly tightens.
And we also have lingering regulatory uncertainty over the renewable fuels market, right?
Exactly. And perhaps most notably, there's a significant presence of executive insider selling at these elevated price levels.
See, that insider selling detail really stands out to me.
It really does.
With debt targets achieved early and insiders actively taking chips off the table, you have to ask yourself a final question. Is Phillips 66 transitioning from an aggressive growth story to just a pure yield play for the remainder of this commodity cycle?
That is definitely the thing to watch.
It is. Well, make sure to follow the show for your daily earnings coverage.